Hey option traders, for today's trade we're looking at an option strategy known as the short straddle in Citigroup stock. This is a great strategy to use if you think a given stock is going to continue to trade sideways for a certain period of time. So looking at Citigroup on MarketSmith, the first thing that stands out is this earnings alert here, which is telling us that earnings are just 7 days away. Earnings for the bank stock are due on January 15th and are estimated to come in at $1.22 a share on revenue of $17.9 billion. As you can see on the weekly chart, the stock has been drifting lower for quite a while now and has come up against resistance several times at its 200-day line. Now the stock is moving above its 50-day moving average, but once again is facing dreaded resistance at the 200-day. So for investors who believe that the stock will continue sideways from here, you could consider using a short straddle to capture some gains in the stock. The options market is currently implying an elevated 5.4% move on the earnings report, while Citigroup has only realized an average move of 3% on prior earnings events. A short straddle is an effective option strategy to bet on a smaller than projected move. As a refresher, a short straddle consists of one short call and one short put. Both your short call and short put will have the same underlying stock, the same strike price, and the same expiration date. The trade profits if the underlying stock trades in a narrow range between the break-even points of the trade, but the profit potential is limited to the total premium received at the start of the trade. The tricky part about this trade is that the potential losses could be unlimited if the stock price rises and substantial if the stock price falls. The maximum profit is achieved in this stock if and only if the short straddle is held to expiration and the stock price closes exactly at the strike price. Here, both put options would expire worthless and you would keep the full premium. So now that you have a better understanding of how to set up this short straddle, let's take a look at my trading platform and set up a trade. So looking at Citigroup, currently trading around $47 a share, here's how we're going to set up this trade. First, make sure you have straddle selected as your spread type here in this box if you're using Thinkorswim. Then we are going to make sure we are in the January 13th expiration. And we're going to select the 47 strike. And to summarize this trade, we are looking to sell one 47 call and sell one 47 put, both with the January 13th expiration. With Citigroup closing Thursday at around $47 a share, investors can consider placing a short straddle by selling the 47 call and 47 put, both with the January 13th expiration. This trade can be placed for a credit of $2.95 per share, which also coincides with the maximum gain of $295 if the shares trade exactly at 47 on expiration. This trade will earn a profit if Citigroup trades anywhere between 43.80 and 49.70 on expiration. Most importantly, in the event of a large earnings blowout, the potential losses are unlimited. Traders can take comfort in the fact that historical earnings moves on Citigroup stock have been low. Short straddles are very risky and advanced option trades, and I can't stress this enough, the losses are potentially unlimited. So if you feel uncertain about anything we just talked about, it is best to practice in a virtual account before risking any real capital. Only try this trade with real money if you have a good handle on the risks of the strategy. Always remember that options are complex and investors can lose 100% or more of their investment. And be sure to join us for our regular options content where we discuss new trade ideas every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.